All right, so maybe you've watched lately in real estate. Obviously, things have changed, particularly in the multifamily space. But one thing that's really been common and has really been steady through all of that is understanding multifamily and other types of real estate debt funds. And debt and equity functions very different in a deal. And there's some actually real advantages to using debt in a deal or being a debt investor versus being an equity investor. You get paid first if there's an issue. Typically, you're higher in the stack. And so there's a lot of benefits to that. And so my friend Ben Fraser is with me today of Aspen Funds, the CEO or one of the operators of Aspen Funds. He's going to get into his background here in a minute, but really excited to talk with him. And we have a lot of common interests. We're part of the same mastermind, which is like a faith-based mastermind that he's part of the board of directors on that. And so we spent some time together and we've been together recently. And he also plays guitar, which I love playing guitar as well. And he's does a lot of music and worship music and things like that, which is awesome. It's also a hobby of mine. So Ben, how are you today?
Good. Thanks for having me on, Bronson. Looking forward to it.
Yeah, I actually listened to an interview that you were on with Justin Donald, where you were talking about stuff, and I love Justin. He's a friend as well, and just really, really great. But why don't you give our listeners just an idea of your background, kind of how you got here, and we're going to talk about some really fun stuff today.
Awesome. Yeah. Well, thanks again for having me on. And you said I was the CEO. I'm not quite there yet, so I'm only the CIO, so Chief Investment Officer, just to be clear on that at Aspen Funds. And yeah, I joined Aspen about 5 years ago. My focus is really on helping determine our investment thesis for the deals we invest in. I'm helping vet and source those deals, and then really kind of capital formation. So helping put together the right capital stack, the right debt, the right, structures for equity on every deal. And so, my background prior to joining Aspen was actually in commercial banking. So I was a commercial lender and underwriter for many years, and, kind of learned, how to break down a deal back in my banking days. And, that's kind of how I got my start. And, back when I was in banking, it was an amazing experience. And I don't know, if you have any listeners that started in banking or in banking currently, but it's a really great place to learn how to, break down a deal, how to underwrite a deal. And honestly, it was really cool for me to see kind of under the hood behind a lot of these high net worth, investors and borrowers, because they'd have to send me their personal financial statements. And I was the one that had to review them, and I got to see everything that they own and everything that they,
I gotta say this is one of the benefits of working in finance. I remember when I had all these calls, even now I have calls with investors, like, what's your net worth? What do you do? And it's like, it gives you an insight into like what wealthy people do. And I know that's been transformational to you, but and also I wanted to say this about your background. A lot of people that are business owners or they have a finance background or something, it's so valuable. A lot of times we think we come to real estate or investing with no experience, but if you've had a business or you've worked in the business world or you've had things that you've been involved with in finance, it's incredibly transferable. And so it just operates, real estate just operates like a business. So that was helpful for you. You got into it from that. You're able to use some of that. So tell us how you kind of obviously banking is very different than working at, buying big real estate deals and all that. Right. So how did that happen? Yeah.
Yeah, well, doing that, looking at, the personal financial statements, and to your point, it was very eye-opening, right? Because you don't generally get to see what the wealthy people are doing. But some of the common threads were they all owned real estate, and a lot of them were business owners, and that was probably the most two common denominators, right? And so light bulbs were going off at some point, and I said, I want to do that too. And I kind of knew going into it, it wasn't going to be a long-term thing. I had enough risk appetite to want to, go out and have more fun on the equity side. But it was a great experience, and I'm really glad I did it. But eventually got the bug, and my father actually is one of the founders of Aspen, and so it was really cool from multiple angles to be able to jump and help them scale. So when I joined, they had just been operating a few years and really exclusively in mortgage notes and building their funds, and then kind of helped scale the business alongside of them for the past about 5 years, and it's been really fun. So it's definitely I've enjoyed the ride, and got bit by the real estate bug.
Yeah, that's great, and that's how it works, right? It's kind of like a gateway drug, right? You get into some little thing in real estate, and all of a sudden you're like, this is kind of nice. This cash flow is nice. The way things appreciate, and all of a sudden you're like, I'm doing all these deals, and it's awesome. So that's great. So talk to us a little bit about. I wanted to start with. We're going to get into what's happening in 2023, kind of what you see happening. You have some unique opinions on that, which I really love. So I want you to share that. But let's talk for a minute about understanding a debt fund as far as real estate? Because I know a lot of deals have this kind of structure where, some of the stack is equity, and a lot of people are really familiar with that because they invest, they get some of the upside, and they get a preferred return as well as the upside. But the debt investors, they might get a lower return, but because they're higher up on the stack, their payments might be more consistent. So can you talk a little bit about kind of why people do that? What you're seeing right now in the market? Is there increased interest in that? What that looks like?
Yeah, I love that you bring that up, because I think it's something that a lot of investors maybe don't look at enough, is the capital stack, right? And what is the structure of how this particular property or set of properties is financed and owned? And, most investors just look for the highest, projected return, I want to get invested in this deal because it's going to give me a 20% IRR. But you have to really look at everything and normalize everything by risk adjusted returns, right? What return are you going to get relative to the risk you're taking? And to your point, debt investing is generally much lower risk because you're paid first, right? And there's a reason why there's a bank in every corner, and it's a good business to be in, because it's good when the getting's good, and it's also still pretty good when the cycle's correct, because the banks are the ones that generally are always going to get paid back unless they're making bad loans. But yeah, the way that we kind of even got started in the real estate space as Aspen, one of our founders, Jim, he'd been in real estate development for 20, 25 years at that point, and he got kind of caught up in the 08, 09 reset, where he was developing spec homes in California, and we all know what happened to spec development in the coast, right? And pretty much overnight that business evaporated. And he kind of had the light bulb moment at that point, where as he's working through, kind of with his lenders on these assets that couldn't finish and couldn't sell, hey, these lenders are actually the ones coming out with probably the least amount of scars of anybody in this whole crash. And it was kind of a light bulb moment to kind of get into the debt side. So, we always say we love being in debt. We just want to be the owners of the debt, right? And so, so we got in that space about 10 years ago, and it's been a great business, a great place to be investing. And so we're generally buying what we call distressed, and then also reperforming mortgages on single family properties. So there's a lot of different types of debt funds. Some debt funds, invest in commercial bridge loans. Our debt fund invests in residential, what's called kind of scratch and dent loans. So there's lots of different types of debt funds. I can get into more, about the different types and what that is. But ultimately, yeah, you're going to maybe expect a lower return. But in our fund, for example, we pay out a monthly return, pay 9%, and we've been doing that for 10 years. And you're never going to get the 20% IRR, but you're going to get 9%, and you can kind of bank on that as income for the kind of income portion of your portfolio. And so it's a great thing to have in a portfolio, not only from just diversification of asset type, but also diversification of the risk you're taking in your portfolio to generate income.
Yeah, there's a couple of points you brought up. I want to mention that first of all, there's good debt and there's bad debt. Of course, that's the first thing is credit card debt is bad debt, and all these gurus that talk about debt there's actually good debt, and if you own the debt, that's even better, right? Because then you're on the side that you're owning this great debt, and then having a diversification, having things that are set up a little different, and you just being an equity investor versus a debt investor. In a deal, it does provide some more diversification. And then also, and I think a lot of people don't realize that there are deals, every deal has a risk. Every deal has risk to it. So where you kind of place in that risk is important. And I know a guy for what I think this was years ago, who was doing like funding flips. And I said, well, you're the money in the flip. You realize like if this goes down, like you could lose all your money, right? Like you're like the most like risky position in there. But I think so understanding kind of where you fit in that stack is important. And then also, you mentioned, okay, so this is I actually know somebody who's invested, and we have a mutual person we know that's invested with you guys, and basically they do it because they have a lot of cash and they can park it somewhere. And then within, I think you guys have like a 90-day or once you have it for a year, then after 90 days, you can say, hey, I need the money back, and get your money back. So it's kind of nice that you have some ability to get liquidity if you need it, which is nice, which is an advantage of this, right?
Totally. Yeah. One of the cool things with our fund in particular, but also just a function of the type of asset is it is a lot more liquid than traditional real estate. So real estate's amazing. We're preaching to the choir, I'm sure, on this podcast, but the one big downside is liquidity, right? You can't get your money out as quick as you may need to sometimes. So you got to take that into consideration. And I'd actually argue it's generally a positive thing. But our fund allows for redemptions because the mortgage note kind of industry is fairly liquid. There's an actively traded secondary market where a lot of these notes are trading hands. People want the yield, and we're generally buying, from the bigger players, the hedge funds and the banks, and so we get them at a nice discount, and then we can sell them to just general note investors that want to own these in their IRAs and can liquidate them pretty quickly. And then we also just have natural churn in the portfolio. So our portfolio's got, I think, 1,300 assets in all 50 states. And we always are getting payoffs from refinances or sale of the property. And it's creating, these liquidity events that we generally just reinvest back into new assets, but can also use that for redemptions. And so it's kind of an income and plus liquidity fund that a lot of people use for that kind of on debt capital, right? So it's not a guaranteed liquidity, but we do our best, and we've never have missed an investor request up to this point. And Lord willing, won't.
Yeah. That's great. So you said you have 1,100 assets in 50 different states. So that's what you guys currently own? Is this mostly like all different types of assets, or what kind of assets?
That's just our one fund. So our one income fund has, I think it's 1,300 assets. Yeah. And these are mortgages, right? So, it's a big number, but again, the, average purchase price of our mortgages it's not the same as a multifamily building, right? Our basis on an average asset is not as large. So our capitalization in that fund, it's pretty much all equity. It's about 75 million in equity in that fund.
Okay, awesome. That's great. So I think really one thing I'm really curious to talk to you about is we're getting into 2023. Obviously, a lot of investors we've watched the last 6-8 months have just kind of been like, I don't know what to do, because interest rates have risen. There's a record amount. I think Bloomberg came out with an article. So there's $5 trillion in Americans' bank accounts. The highest ever recorded before that point was in 2020, right before COVID, with 1.2 trillion. So we're at 4 to 5 times the amount of cash just on the sidelines. So what do you think? First of all, what do you think is going to happen as far as rates? Do you have any opinions on that or any ideas? And also, what do you think as far as real estate? And what would you say to an investor who feels very cautious right now? There's like 3 questions there.
Yeah,
I'd like to stack them up.
Parse it down. Yeah, no, I think those are all amazing questions, and just a little more context for just what we do. And so we've been doing the debt funds for a long time, but a few years ago we transitioned to what we call kind of macro-driven investment themes. And so we now invest across all asset classes, as long as they're supported by macroeconomic trends that we believe in. So we've since invested in industrial real estate, multifamily, self-storage, retail, even oil and gas, and have found some great opportunities there. But we're constantly looking at what are the bigger picture trends going on, and how do we position ourselves as investors to be in the best possible position, right? To be in that rising tide that's going to lift all the boats, as opposed to the decreasing tide that you're going to start hitting rocks once the tide goes out in your boat. So all that to say, yeah, we're definitely paying a lot of attention to what's going on, and with what's going on the past 6 months, it's been historic, right? I mean, the increase of interest rates is the fastest that has ever happened in at least in the past 50 years or so. And it caused a lot of turmoil because investors don't know how to react, right? I think the first response is, I'm just going to hold up. I'm just going to wait and see what happens, right? Because when you don't know what's going to happen, you investors generally want to just sit on the sidelines, right? And that's understandable. And I think it was as trustworthy as the Fed is in all of their minutes and everything that they say.
No pun intended, right?
No pun intended. Yeah, if you can't see my face, yeah, I'm making a smirk here, but yeah, I mean, it's hard to know and to navigate these waters. Actually, on that point, we had on our podcast a few months ago, we found this meme on the Fed, and it took little sound bites of things that they were saying over a course of 6 or 7 months, and just how the story has changed so dramatically from, inflation is transitory to, we basically got to wreck the economy into recession to get inflation back under way. But I mean, I think my opinion on interest rates, and I do think, we are going to see a slowdown of rate increases, but the Fed, they've remained pretty hawkish, and I think they basically are backed into a corner where inflation is not reacting and responding, i.e. by going down in the way that they probably would have hoped. And, I do think the rate increases are going to slow down, but I think we're going to still see rate increases, through the next few quarters. And I actually, my personal opinion is that we're going to see elevated interest rates, elevated meaning, above 5% on Fed funds rate for probably 18 months plus. And I think a lot of investors don't want to hear that. And I think I initially, as an investor too, and so my deals, right, I had some early exits that I was hoping to sell and, cash out on. That timing didn't work, right? So we're finishing the business plan, other things, but it's, I think the reality is, as we've studied the contributors of inflation and the things that are driving inflation, they're going to have a very hard time stymieing inflation with this monetary policy. It's just they're you can only do so much with monetary policy. And if their primary goal is to get inflation, around that 3%, I think it's going to be a while. I think it's going to be stubbornly high, both inflation and as a result, interest rates for a period of time.
Yeah, no, I agree. I think it's interesting because there's a lot of trends. If you look since 1952, from the day of the first rise in interest rates to the day of the first federal cut, as far as interest rates, it's the longest ever is 13 months, and the average is 5 months. But now we're in a unique time, and I'm interested to see kind of what that will look like. And you talked about it too. I think with inflation being high, and I think it's much higher than what they say. It's not 7.1; it's probably like 15%. I think if you actually look at it, but there are certain things investors can do to really protect themselves. So what do you think? I mean, like you said, the confused mind will say, and I talk about that too. The confused mind says to wait. I'm not sure. And, a lot of these multifamily deals are getting squeezed right now, and we're seeing it. I mean, you're seeing it as well, that deals that have a limited, a 2-year type of loan on it, which is about 85-90%, particularly of multifamily. And we all thought we were geniuses because we got these interest rate caps, and now it's like an insurance to make sure the interest rate doesn't go higher. But now those insurances are costing 20 times as much as they were a year ago, right? So what do you think there's going to be some distress in some of these situations? And what do you think? What do you think the opportunities will be if there is some distress, particularly in multifamily, large multifamily, in the next 12, 18 months?
Yeah, I definitely think there's going to be some distress. And, I think it's not because multifamily isn't a great asset, right? I think we all agree that multifamily is very well poised to perform well in inflationary environments. So that's not the issue, right? But, I've heard several people say, the biggest way that a deal blows up is the debt, right? What does the debt look like? Because, coming from a banking background, when banks' appetites change very quickly, and we've already seen that, right, on new acquisitions that you're doing, we're doing, where bank appetite is just not as strong as it was 6 months ago. And what if this environment continues for a period of time where banks they want to take cash off the table, they want to take risk off the table? Well, as these loans come due and the maturity dates start to hit, which basically means a borrower has to either refinance the loan or sell the property or have to negotiate with the current lender, right? Those are your only options when a loan comes due. And at good times, it's generally not that hard to refinance. You go into a Fannie product or something, or, if it's a good time, you can sell. But at a time like this, I read a report the other day that I forget the exact stat, so I don't want to say it, but it was, a healthy portion of a lot of the loans that are coming due, agency loans that are coming due this year, or sorry, bridge debt, not agency, will not be able to get refinanced based on current NOI at current interest rates. And So the only options, and they're basically saying it would have to be a factor, NOI would have to increase by a factor of I think 50% between now and when these loans come due, just to hit the debt service coverage requirements on a refinance. And so you think about what that actually means. A lot of these deals, like you're saying, they have gone through the interest only period. They've hit the rate cap, which was great for when it was needed, but the interest rate still may be high. And then I think we're going to see some deals start to fall out. And I think I'm not a big doom and gloomer. I think there's definitely going to be some carnage, and I think banks first line of defense will be, we'll just extend the loan. But they can only do that so long, right? And I think it's just kicking the can down. So I think maybe it's not going to be 6 months from now that we're going to see all this matriculate through the system. But I think it's going to be 6 to 12 months. We're going to start seeing some distress. And I'm in a few masterminds, and I know you are too. And there's already I'm seeing operators that are new operators that are in difficult positions, and they're raising the white flag and saying, "Hey, I don't know what to do here." Right. And I think that's going to happen more and more. And so, from an investor standpoint, I get excited, right? I know you do too, because this is when the best opportunities come around, right? When, a year ago, 2 years ago, when everybody's trying to compete on all the deals,
there's
and
30 offers on a property,
30 offers on a property. And, that's when it's hard. It's hard to find good deals. And, when, a lot of capital is scared and, deals are falling apart, that's actually the best time to be buying. Yeah. And so, I'm telling our investors, saying, hey, we're being very, very selective. We've passed on more deals than we've ever, passed on, because we're being very, very picky. But there's also going to be the unicorn deals that you want to be ready for, because this is when you can really make outsized returns, when you can get into deals at a really good basis and a good time, because the fundamentals of real estate and a multifamily are there, right? They're there.
Yeah. And Warren Buffett, we talk a lot about Warren Buffett on this show, but be fearful when others are greedy, and be greedy when others are fearful. And it's getting to the point. I mean, we're not, there's a term also of like there being blood in the streets, right? Where it's like, we don't necessarily blood in the streets, but there's like the sharks are swirling, right? You kind of see like, okay, they're coming. And so, what is a crisis for some is a great opportunity for another. So I think it's really important to pay attention. I think there's a lot of opportunity out there, and you brought up some examples of what that's going to look like. And I think too, it's interesting with multifamily, you have these, I talk about there's inflationary factors and deflationary factors, right? There's things that are, inflationary, meaning that, there's so much demand right now for multifamily. We're 3 to 8 million apartment units short. Interest rates have been low. There's just this incredible demand. I mean, rents are up. There's a lot of things right there. And then you have the other issues that are like, what about a recession? What about this? What about interest rates? And these things that are kind of risks are on the other side of the equation. So it's really important that you look at everything. I want you to talk for a minute. I know we got a few more minutes. I want you to talk for a minute about REITs. I know a lot of investors like REITs because they're pretty passive. Feel like, hey, you get some diversification, but there's some things about REITs a lot of people don't know. And I think you mentioned on Justin Donald's podcast, just talking about, it's not actually just directly investing in assets. There's kind of a spread between what the actual value of it. Can you talk about that a little bit?
Yeah, absolutely. So, we talked a lot about our podcast, and, the REITs, they, real estate investment trusts, and they're generally publicly traded. Not always publicly traded, but that's kind of where most people see them. Their investment advisor says, hey, let's get you some real estate exposure and let's get into some REITs. Well, that's great, because the underlying purpose is generally to invest in real estate. But there's some major disadvantages of investing in REITs versus investing directly into real estate, via private equity or syndications or funds. And, some of those just real simple, disadvantages are, one, you don't get the tax benefits, right? As we all know, real estate investors, the tax benefits are, unparalleled to anything else in our tax code. But I would say the bigger issue is people don't really know what they're investing in. And so, a lot of people understand the idea of a price to earnings ratio, right? It's a valuation metric that's used. Warren Buffett, he's a value investor. So you want to invest when PE is low, right? Your price relative to your earnings, you want that to be a good value. So you want that to be low. You're not paying too much for what that stock will generate. Well, a similar metric when you're evaluating, asset-based, investments in the public markets is price to book. So basically the book value is what is the balance sheet value of those assets, relative to the price you're paying for those assets, right? So if the investor's investing $1, in one of our deals, they're investing pretty close to $1 directly into real estate. That dollar will own mostly all real estate, right? Well, if you're investing in a REIT, that $1 is likely going to own only 20% or less of real estate. So price to book is about 5x. And
Wow.
some of these trade well beyond that, into the like 9 to 10x. And
Wow.
so basically meaning you're investing $1 into this REIT, you're only getting 20 cents of real estate. And what is that, right? Well, why are you're paying so much for it? Well, it's, advisors would say it's the liquidity premium, right? So
Right.
REITs do have an advantage, which is liquidity, which we've talked about that, private real estate does not have. But to me, it's not worth, 80% of my investment to have access to my funds when I need them, because I also know as human nature, I'm an emotional investor too, and I fight the same thing as every other investor, where it's hard not to sell when you're down, right?
Yeah.
And actually, lack of liquidity, illiquidity can protect you in those environments. And so it's arguable whether it's an advantage or a disadvantage, but the point is the valuations on these REITs generally are very, very extreme relative to what you can do directly in real estate.
Yeah, thanks for sharing that. I think that's really great. What, you guys do a ton in real estate, and you have your awesome podcast, Invest Like a Billionaire. I highly recommend people check it out. It's really a great show. What are some other assets that you like that are outside of real estate? Are there anything that you maybe personally are like, oh, I invest, or is pretty much 100% of what you do in real estate? Can you maybe talk a little bit about that?
Yeah, I'd say probably 80% of my net worth is in real estate, right? And I love it for a lot of reasons. But I've done a little bit of venture, very, very minimal, and I don't know enough to be dangerous there, but just more just for fun. But one asset class that we're very bullish on right now, and we've done an offering end of last year, we'll likely have a few more this year, is in the energy space, in oil and gas. And
Yeah.
we break this all down in some episodes in our podcast, but we believe one of the bigger contributors to inflation, it's obvious, it's been energy, right? The cost of energy, and it's so fundamental to the lifeblood of our economy, and energy fuels everything. And if energy remains elevated, the price of energy remains elevated, it's going to keep inflation high. But there's also some major kind of just fundamental supply and demand challenges going on in the oil and gas kind of asset class right now that are very, very interesting, that we have not really seen for a long period of time. And the real simple, part of it is the kind of green energy transition. The ESG movement has kind of pushed this narrative that, hey, we all want renewables, which I think most of us can agree, hey, that's good for the long-term future of our planet. I'm great with that. The challenge is it's a very politically driven narrative that is disincentivizing, hydrocarbons and oil and gas, and really to the detriment of consumers, because what's going to happen is it's going to take a long time for this transition to occur. I mean, likely, 30, 40, 50 years where they want it to happen in the next decade. It's not possible. It's simple math says it's not possible, but that's what's being told. And then, simultaneously, they're disincentivizing banks from lending to, traditional oil and gas producers. And so what's happened is the capital investment into the oil and gas sector for the past 7 years has decreased by 50% of what it was in 2015. And anyone that understands oil and gas knows that it's a depleting resource, right? There's a limited amount in the ground, and it depletes over time. And so if you're not continually putting capital back into the ground to pull out more and find other wells, then you're shooting yourself in the foot for future supply. And so what's happened is there's a big constraint on supply. There's been a minimal lack of investment into new supply. And meanwhile, demand, hasn't tailed off to the way that, the political narrative would want and actually can't support. And so we actually believe, and we've brought a lot of oil and gas economists and a lot of other third-party research that we've done, and believe that it's it's going to ebb and flow, but it's going to remain elevated for a period of time, and it's we believe a good place to put some capital in. This year.
I couldn't agree more. There's everything you said I completely agree with, and there's a great book by Alex Epstein, 2 books actually. One is called The Moral Case for Fossil Fuels, and I like to read books that are kind of a little bit counter narrative. Like that's very different than the narrative. Like, oh, we should feel bad for using our cars and flying on planes, but like it's kind of like, no, our lives are actually much better off because we have fossil fuels, and these other alternative energies have been around for 100 years, solar and wind and some of this stuff. And we have 3% of the world's energy being produced so far. So I don't mean to get political, but it's like, we just can't get there as quick as what they say. And so I think investing in a scarce resource is incredibly valuable. So, well, Ben, we're getting short on time here. I wanted to say, I really appreciate you. I've really enjoyed our conversations. I love that you approach investing both from a very intellectual and very smart approach, both you and your father as well. And your podcast is awesome. I highly recommend check that out. Invest Like a Billionaire. And I love that you're also a person of faith. You have values behind what you're doing. It's very evident what you do. You're really eager to help investors and help people. What's a good way for people to get in touch or to follow what you're doing?
Yeah, I appreciate that, Bronson. And best way to get in touch, if you like podcasts, we have ours called Invest Like a Billionaire. You can go to thebillionairePodcast.com. And then, our private equity firm is Aspen Funds, aspenfunds.us. You can find all information of open offerings and other things for accredited investors there. And really appreciate you having me on, Bronson. It's been really fun.
That has been great, man. Thanks so much.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.